Corporate Finance Excel Practice Problem. In this presentation, we will work a practice problem in Excel related to calculating the cost of ending inventory using both the last in, first out and first in, first out methods, otherwise known as LIFO and FIFO. Get ready, it's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into our worksheet on the right-hand side. We're going to be using the first in, first out method. We'll calculate the gross profit and the cost of the inventory. So we got a little bit more information with regards to the inventory that will then apply out into our flow assumption, that being the first out, first in, first out method. Okay, so we have the materials. So notice whenever we make inventory, so if we're producing the inventory, that's going to be different than if we just purchase and sell the inventory. If we produce it inventory, notice you want to break it down into three categories. There's basically, no matter what you produce, you can kind of break it down into three categories of the things that you're going to need in order to make the inventory. One being materials, two labor, three overhead. Now these could vary greatly with the different types of things that we make, but these are the three typical categories we have: the materials that go into what we are making, the labor that we use to make them, and then the overhead, which is basically everything else that we're going to have, that we're going to apply to the process of producing the inventory. So then we're going to have the beginning inventory in units is going to be the 9,700, and the units that we're going to produce are going to be the 22,000 units. The material cost per unit is going to be $10. That's for the beginning units that we have. Labor and overhead costs are the same. Or in other words, the units that we produce, the materials cost will change to $10 from $5. That's a significant change. But the labor and the overhead will remain the same. We're going to be using the first in, first out method. Then we have the sales in units. We're going to be selling 28,000 units. The sales price is going to be $22. So remember, what we're talking about up here is the cost to us to make the units, the cost of the units, cost of goods sold, versus the sales price, what we sell them for. These two are not directly related, but obviously we would use the cost of the units in order to figure what the sales price of it will be in order to get a sufficient profit margin to meet our fixed cost needs as well as a sufficient amount of profit. So the beginning inventory, let's first calculate the total cost of our inventories. Let's think about our inventory costs just in general. So we'll pull together a little worksheet here. We're going to say, all right, the beginning units of inventory, let's say those are that 9,700. Let's break out the costs of that inventory. When you think about the cost, it's useful to think about these three categories of costs. That being the materials, the labor, and the overhead. So the materials are going to be, well, let's do it this way. Let's add a subcategory here and put a colon, and then we'll put the costs into the inner column. So I'm going to then say that we have the materials are going to be, the materials are $5. We'll pull that into the inner column being the $5. We'll pick up the labor then, the labor at the $5 as well, but it's like that second $5. And then the overhead, everything else other than materials and labor, such as anything on the factory, for example. If we make the inventory in a factory, like the utilities and whatnot of the factory, we're going to apply out the $4 here for that. Then we're going to have the total cost, or let's say unit cost, the total unit cost. Well, then I'm going to sum these up in the outer column now. I'm going to say this equals the sum of the 4, the 5, the 5. So this is per unit. The 14, let's put an underline here. Let's work on some formatting. Home tab, font group, underline. Let's indent these. I'm going to select these items. Home tab, alignment, increase the alignment. I'll increase this one more time. Home tab, alignment, increase in the indenting. We're just focusing in on practicing just the formatting of what we have here. And then that's going to give us the total inventory costs. So I'm going to say the inventory cost at the beginning inventory cost, which is going to be equal to the 9,700 times the 14. So that's basically the cost at the beginning. Let's go and format this with an underline, home tab, font group, underline here. And then we have the new units that we are producing. So let's say new units that we produced during the time period, the current time period, is going to be the 22 units. Let's calculate our cost per unit once again. So now this is going to be the unit cost for the new units that we produce. I'll put the colon here and we'll have the same process. We're going to have the materials, the labor, and the overhead, but it may differ, right? So now we're going to say the materials went up per unit to $10, but the labor and the overhead remain the same. So there are those items, and that's going to be the total unit cost for the new production that we're going to have that we will pull out into the outer column. So I'll pull that out in the outer column. Let's paste it this way. Pull that out into the outer column equals the sum of these items. So there we have that. Let's go ahead and indent these. Same formatting. I'm going to select these items. Home tab alignment, increase the indenting. Let's indent this one again. Home tab alignment, increase the indenting. Let's put an underline under the 4. Home tab font group underline. And then we're going to be calculating, let's put an underline on the 19. Home tab font group underline. Let's calculate the total new production cost for the new products. And that's going to be equal to the 22 units times the $19. So the total cost for the beginning units equals the beginning units, that 135.8, and the new units, which is F10 and F17, is going to be that 553.8. Let's put an underline here, home tab font underline. So that would be the units that are kind of available during the time period. Now we sold some of those units, and we're going to assume the flow assumption is a first in, first out method. So FIFO type of method. So let's do our standard worksheet for FIFO. We're going to say, all right, the beginning units, then we said that we had the 9,700. The cost per unit we have now calculated to be that 14 for the beginning units. The total then is equal to the 9,007 times the 14. The current units produced, current units for the month, current month production, and this is going to be the current month activity that we're going to have here. And that's going to be then the, how many units did we make this month? The 22. We say those are now costing 19. The $19. If we multiply those out, we're going to get the 418. So then if we sum that up, we're going to get the total. So we'll total this up. And we're going to say this equals the sum of these items. This equals the sum of these items. We'll put an underline here. I'm holding down Control and underline here to highlight two non-adjacent cells. Home tab font underline. All right, then we're going to say, okay, we sold some of these items. Now they sold in units, 28,000 units. Now note when they sell units and they give you the sales price, many people will get confused with the sales price and confuse it with the cost. The sales price is what we sold it for. It has nothing to do with the cost flow that we're working on now. We'll talk about the gross profit and see where that comes into play later, but we still have to do the cost flow assumption. That's kind of the confusing point when we add the sales price. We're doing so much focusing on the cost that when they give us the sales price, we forget about that's usually the first thing that comes in our head is the revenue side, but we're working on the cost side. So we're going to say, all right, it's a FIFO method. We sold 28,000 units. So we're going to sell these first, the old units first. Notice we have the standard process or the standard scenario where prices are going up over time. So I'm going to say, we're going to assume we sold these items first at the $14 cost, the beginning units, the 9.7 times the 14. Then the rest are going to have to come out of here, which will be the 28,000 units minus the 9,007. So this is going to be equal to the 28,000 units over here minus what we had up top. That's going to give us the 18.3 of the 22,000 units that of the ones we produce later that we're going to sell, because these two then will add up to the 28,000, which is the number of units we sold, and we're going to sell them in accordance with FIFO, first in, first out. So we're going to be picking these up at the $19 per unit, multiplying this out, the 18.3 times the $19. There we have that. Let's go ahead and sum this up. The units that we sold then equaling the sum, that's that 28,000 that we sold in units. In dollar amount then, using the first in, first out flow assumption, 483,500. Let's put an underline here and here. I'm holding Control in order to highlight non-adjacent cells. Home tab, font, underline. What does that mean that's going to be left in ending inventory? Well, These units got wiped out because we sold all those, so I'm gonna reflect that with a formula. This minus these, they're gone. Those 0 units cost $14. The 0 units times the $14 unit cost would be 0. And then of the 22,000 that we produced at $19 price, 18,300 were sold, leaving 3,007 at that $19 price. The 3,007 times the 19 gives us our 70,300. Summing up both sides, summing up here and summing up there, we can then underline here and there, selecting non-adjacent cells using Control to do so. Home tab font group, underline. This is what's going to be left in ending inventory. So now let's think about the gross profit, which is the income statement. Let's think about what's going to happen on the income statement. Well, we're going to have the sales in units. So the units that we sold is going to be that same 28,000 units. We sold that many units. But the sales price has nothing to do with the table that we did up top. And you might say, well, it should, because the sales price should be based on the cost somehow. Yeah, that's fine. They're going to use the cost somehow to figure out what the markup that they need to have in order to figure out what the sales price should be, but we don't know what that direct relationship is, right? We know we've been working with a cost here. The sales price will be given typically separate in like a book problem and will need to be determined using a projection in practice. So we're going to say that underline that, home tab, font group, underline, and that's going to give us our sales amount, our revenue or income amount, in other words, being the 28,000 times the 22. So there's our sales price. Now, what's the cost of goods sold on the income statement? The expense related to the units of inventory that we consumed in order to generate that revenue. It's going to be equal to that 483 using the first in, first out method. Subtracting those out, the 616 minus the 483.5, that gives us our gross profit. Let's underline here, home tab, font group, underline, and we are left with our gross profit. That's not the bottom line number of the income statement. That's kind of like, sales minus cost of goods sold. Then we have all the other expenses that we have to cover with that gross profit amount. But that subtotal is obviously useful if we sell inventory. So this is what happens on the income statement. What happens on the balance sheet is we're left with this 70,300 on the balance sheet, which represents 3,700 units still left over. So that'll be the beginning of next time period, the ending of this period, and they cost that $19. Let's do a similar process, but this time using the last in, first out method. So next tab. Here we are on the second tab. We're going to do a similar process, this time with LIFO, last in, first out. Similar layout other than that. So we have the information on the left, the beginning inventory items, the material, labor, and overhead. And we got the beginning units that we have. And then we're going to produce in the current time period another 14,200 units, and then giving the cost for material, labor, and overhead related to it. We're going to be using the LIFO method. Sales that we're going to have in units for the current time period, 16,000. Sales price, 19. All right, let's go through this. Again, the questions they could ask, gross profit, that's what they're asking for here. They could ask, that basically is telling us we need to calculate the cost of goods sold, but they could ask for ending inventory as well. So we're going to figure all of those things out as we go. We'll do this a bit faster. So we're going to say, all right, let's do our worksheet. Now, you don't have to do this worksheet over here, but I think it's good to emphasize the fact that we're kind of adding in another component, that being we're breaking down the inventory to its parts of material, labor, and overhead. So if you have a production company where you actually make the inventory, you'll break them down to those parts. If you're a retailer and you're simply purchasing, marking up, and selling inventory, then you're going to do a similar process with LIFO, possibly, if they're all like similar kind of products, or FIFO, whatever your flow assumption is. But you won't have to be dealing with the production factors of material, labor, and overhead. Those were done by the production company. But remember, anything that you have that you bought somewhere was, when produced, built, and you can break down the cost into the components typically of material, labor, and overhead. All right, so let's do this. We're going to say beginning inventory. Beginning inventory. Let's do that again. Hold on a sec. There we have it. It's going to be that 4,100, and then we're going to have the unit cost that we will calculate for that inventory, which is going to be consisting of the material, the labor, the overhead. So that should just be standard whenever you think about a production company or inventory in general when it was produced. You can break out the cost of inventory, material, labor, overhead, which is like everything else. Material, labor, and then like everything else that they put into the cost. And that's going to give us the total cost of cost per unit of beginning inventory. And this is, let's put our underline here, home tab font underline. Let's go ahead and sum this up in the outer column equals the sum of, and we'll pick up the 4, the 5, and the 2. And then we can calculate the total beginning inventory cost then, which is going to be equal to the 4,100 times the 11. And now let's look at the new units that we produced during the time period. So we produced then another, I'm going to put this in the outer column, 14,200 units. Then we're going to be taking a look at the components of those units to get the unit price of the current units made. And that's going to be consisting of, once again, materials, labor, and the overhead. Material, labor, and overhead, which now are different amounts. Those amounts being the 5, the 7, the 4. Let's underline here, home tab font group underline. And then we're going to say this is going to be the total unit cost for the new items that were produced. Summing those up in the outer column equals the sum of the 5, the 7, the 4. And then that's going to give us the total new production costs, the cost for the new production. I'm going to unformat this so that we can work on formatting it together. So total new production, this is going to be equal to the 14.2 times the 16. Let's underline this, home tab font underline, and this will give us then the total cost then being equal to the beginning inventory 45.1 and the new production 227.2. Let's underline here, home tab font underline. Let's do some indenting. There's a colon subcategory, so let's highlight these or select these. Home tab font indent. Let's indent this one again. Home tab font indent. Do the same thing. There's a colon here. Let's select these items and go to the home tab font indent, and then indent again here, home tab font or alignment indent. Okay, so this is the total cost of all the units beginning and the ones that we produced. Now let's take a look at our LIFO assumption. So now we're doing last in, first out. So last in, first out, our beginning inventory is going to be equal to then the units of the 1,400, those costs the $11. So the $11, and if we multiply those out, we get the 4,001 times the 11. That's going to be the 45.1, same item we calculated here. And then we produced more units. So we produced more units, meaning we made 14,200 in the current month. And those costs, as we figured down here, 16 per unit for material, labor, and overhead. Multiplying them out, the 14.2 times the 16 gives us the 227.2. That gives us a total, if we sum this up, the sum of the units, 18.3 in units, the sum of the cost in dollars for the inventory, the 272.3. I'm holding down Control to select two non-adjacent cells, home tab, font, underline. Okay, now which ones did we sell? That's going to be the second component here. We're going to sell under LIFO the newest ones first. So we're going to clean out these items when we sell, as we sold 16,000 units. So we're going to say all of these are gone. The 14.2 at the $16 have now been removed. So we're going to say 14.2 times 16. We're going to sell all those, and then we need to sell the difference between 16,000 and 14.2 to get up to what our total is of the 16,000 minus the 14.2. So now we're going to cut into the prior layer of the $11 layer, the cheaper layer, even though they're the same unit things that we're making. 1,008 times 11. Let's sum these up, equals the sum of these items. Let's equals the sum of these items. Let's do our underlining, Control, holding down Control to highlight two non-adjacent cells or select two non-adjacent cells, home tab, font group, underline. All right, so now let's see what's left in ending inventory. Well, this second column has been wiped out, meaning if I take the units that were there, we sold all of them, or we assumed we sold all of them. Those were the $16 units, the more expensive ones. So if I take 0 units left times 16, we have no cost left. The prior layer where we had 4,100 in beginning inventory, we assume that we only sold 1,800 of them. So the cheaper ones we still have of those $11 ones. Again, this is just a flow assumption because we don't know which ones we actually have. And so if we multiply these out, there's the 2003 times the 11. So we got the cheaper ones are left in ending inventory. We assume we sold the more expensive ones. Again, even though they're all the same, it's just that the price went up over time. And so that means that the cost of goods sold would be higher under LIFO than FIFO because we have increasing prices, which is normally like the normal circumstance, increasing prices being the norm. So then if we take the sales, then we're going to be picking up the sales in units, which means we sold, how many units did we sell? This 16,000 units. And then the unit price. Now this is where it's often confusing because people want to pick up the unit price, the sales price from this information that we've been working with. And that it doesn't have anything to do with this information. We might use this information to derive the sales price, but there's multiple methods to do that. The sales price is different than the cost. So in a book problem, they'll give us the sales price if we're focusing on cost flow. Don't confuse the two because it's easy to do so. And you want to avoid doing so because it can be confusing when you confuse them. So then let's multiply these out. We're going to say the 16,000 times the 19 units. And then we have the cost of goods sold, which we figured from our worksheet, which is this cost of goods sold at the 247,000 to give us the gross profit. The gross profit is going to be the 304 minus the 247. Let's go ahead and put an underline here. Home tab font group underline. So note that the cost of goods sold here is now using LIFO higher than it otherwise would be, using LIFO making the gross profit and therefore net income at the bottom line of the income statement lower. So it makes us look kind of worse, which you only want to look worse usually when for taxes. Now, if these two were reversed, meaning we had decreasing prices over time, which is unusual, but can certainly happen, then the opposite would be true. And then ending inventory also has on the books, it's lower than we would think. So it makes us look worse once again, because what's left on the books are the cheap units, the ones that we're applying the lower cost to. Therefore, our assets will be lower than they would be under the first in, first out method. So LIFO will be lower than under first in, first out if there's rising prices, which is the norm. All right, let's do this one more time. We'll do this one more time. We'll go much faster this time. Same kind of scenario. We're going to be using LIFO again. That's usually the more confusing method. So I want to just reiterate it one more time so we can kind of practice taking a look at it. Same basic information. So let's do this a bit faster. Practice the formatting. We're going to say the inventory beginning 10,000 units. We got the units beginning inventory, and the per unit will consist of materials. I'm going to use our autofill now to copy this down to note that it's going to notice how it picks up the formula down even though we're using words. We're going to then pull the amount, which is going to be the 15. Notice I have decimals over here now because I have cents that I need to deal with. So I'm going to go to the Home tab font group, increase the decimals, and then I'm going to autofill this down again, putting my cursor on the fill handle, dragging it down, it once again taking those cells and formatting the cells for me. Then I'm going to go to the Home tab font underline. We're then going to say this is going to be the total. This is the total costs. All right, let's call it this way. Let's say it's the total beginning balance unit cost, and that's going to be equal to the sum of these items. I'm then going to add pennies. Home tab numbers, adding pennies. Check my spelling just for the fun of it. All right, totally spelled it right. I'm like paranoid on the spelling, but I was right. I spell good. And then we're going to say this is going to be the 10,000 times the 2950. Let's put an underline here. Home tab font group underline there. Then we're going to be picking up the new production units that we will then have, which are going to be the new units that we make, the 44.3 that we're going to be making. And we're going to be picking up then the unit costs for these items. Unit costs, which will be the same kind of information we had before for materials, for labor, for overhead. But now it costs us a different amount, which is that 14. Let's go ahead and add the pennies here. Home tab font group, add some pennies. Let's autofill it down, putting our cursor on the autofill handle, dragging it down. Let's put an underline down below here. Home tab font group, underline that one. And then we're going to say that that'll give us the total unit costs for the new ones that we made. And we'll put that in the outer column equals the sum of the 14, the 680, the 730. Let's add some pennies. Home tab font group, adding pennies. Let's then put an underline. Home tab font group, underline. Then we're going to have the total new production cost, which is going to be equal to the 44,300 units times the 2810. So there we have it. And I'm just going to then say that we're going to have the total cost then total. So I can just type that here, total. I'm unlikely going to misspell that one. I can spell that one for sure. And that's going to be equal to the 295 plus the 1,244,800. For the 1,539,830. Let's put an underline here, home tab font group, underline. Let's do our FIFO thing now, which is the last in, first out flow assumption thing that will calculate the cost of goods sold and the ending inventory using the last in, first out. So we're starting with the units that we had, 10,000 units. Unit cost being the 2950. Let's put a decimal here, home tab font group, add some decimals. See the pennies, want to see the pennies involved. 10,000 times the 2950. And then we have the current month activity that we made more inventory. More inventory was made. And that was, we made 44.3. And the unit cost was 28.10. 28.10. Let's add some pennies there. Now notice it went down in price. That could happen. Why did that happen? Because the materials went down in price. Now, all else equal, you'll typically have inflation and materials will go up, but materials could go down because there might have been, if we make something that deals with an input from, beans or something, and beans are cheaper this year because there's a good year of bean production, then, it would go down. So then that could quite well be the case. And then your question will be, well, what's going to be the effect on cost of goods sold and ending inventory? Well, the reverse than the norm. Okay, so let's do it, and then we'll talk more about that once we're done. So let's sum this up. We're going to sum these and equals the sum of these. Let's put an underline here, holding down control to select two non-adjacent cells, font, tab, underline, and this will be the total. Let's just call it total. I could spell that. So I don't need any help. Spelling that one. So then we're going to have the sales here. We have other units that, or the sales units that we had. We are selling 48,000 units. So which ones did we sell first? We sold the later units here, now being actually the cheaper units, which is kind of weird. So that's the reverse of the norm. But we still sold the later units. So same process here. We sold the later units. They just happen to cost less than the earlier units. Let's add some decimals. Home tab font, adding a few decimals, putting the pennies in. Then we've got the 44.3 times the 28.10. And then we sold the rest from the upper layer, which I'm going to say is going to be equal to the 48,000 units we sold in total, minus the 44.3 in the later layer, giving us these 3,007 that we're going to cut into the old layer in. And those cost $29.50. They actually cost more. Let's add some pennies to that. Home tab font group, adding a few pennies. Then we're going to say equals the 3,007 times the $29.50. Let's sum this up now, equals the sum of these two. And then we'll say equals the sum of those two. Let's put some underline in here. So underline that one, holding down control, and that one. Home tab font group, underline. What's left then in ending inventory after this process? Well, this one got wiped out, so because that was the 44.3 that we had, and we took all of those out because we assumed we sold all of those, so there's none left, and those cost $28.10. but we want to add pennies. Home tab font group, adding some pennies. That means that 0 times 2810 is 0. We then have left in ending inventory for the old, the first layer. We had 10,000 and we assumed we sold 3,007 of those. Those cost $29.50, but we need to add pennies to it. So home tab font group, adding a couple pennies so we can see the decimals. So that means that we have the 6,300 units times the $29.50, giving us the $185,850. Summing this up, bottom line then, we have that plus the sum of the dollar amount. Let's put an underline here and there, holding down Control to select two non-adjacent cells, home tab font group underline. Gross profit calculation then. What's the gross profit calculator? What's the effect on the income statement? Well, we got the unit sales, which is going to be the number of units that we had. We sold 48,000 units, we said, and then the unit sales price. Remember, don't get the sales price confused with anything we've done up top. Has nothing to do with the cost, which is what we've been working with the LIFO assumptions. They will typically give it to you in a book problem, and in practice, we would have to figure that out, possibly based on the cost, but we can use different methods to do so. So those are two different things. So then we got the sales or revenue, which is going to be equal to the 48,000 times the 40. That's going to give us then the sale. Then we have the cost of goods sold. Now the cost of goods sold is what we've been dealing with, the cost of the stuff that we sell, and that's going to be then the 1,353,980, and then home tab font group underline. We're then going to say that's going to give us the gross profit. This is the gross profit. Makes so much profit, it's gross. And there we have it, the 566.20. Okay, so there we have it. Now, just to note here, this was the unusual circumstance where prices are not going up. So I would think about this process as if normal circumstances, prices going up, LIFO will make you look worse under normal circumstances. This is not normal circumstances. Prices went down, so LIFO will tend to make you look better. It'll be the reverse. How would it make you look better? Well, that means that the cost of goods sold here, we assumed we sold the later items, which is still in line with what we did before, but the later items are now cheaper than the prior items. So that means the cost of goods sold now is going to be less than what it would have been under FIFO because of this weird circumstances of prices actually going down. And that means that the gross profit then would be higher than normal. Net income would be higher than normal. The ending inventory, notice what we're left with are the old units, just like normal, but those old units now are actually more expensive than the new units, which is reversed to the norm, which means that the ending inventory for LIFO, instead of making us look worse like it normally would have if we had inflationary periods or increase in prices, increase in costs, is now making us, the last in first out makes us look better. Our ending inventory, in other words, is higher. The assets would be higher on the balance sheet that are left over than otherwise would have been if we used the first in, first out assumption.